Hi guys, welcome back to the channel. My name is Dave, and today we're talking value stocks. I love a nice correction. We're in a little bit of one right now, and I'll tell you what, I'm all fanged out. I'm not adding FANG, I'm not adding tech, because the tech floor is way down there. For stocks like CrowdStrike that I like and I own, I'm just not adding to those positions. The valuation is just a little bit too rich. Now you could approach this by buying an ETF, which I think is a good idea. You could buy VTV, a nice value ETF, but I want to cherry pick right now because what I've seen in this very erratic market is stocks like Pfizer coming well off its 52-week high. I was able to pick up some shares. Here's the chart. And, it was just a great buy. And now it's gone back through the roof here. And now Bristol Myers, same thing, big correction. No news at all that I could find, but I was able to pick up some shares. And now I see it moving higher again. So I see there's a lot of stocks out there that we could cherry pick and add right now in that value arena. This market, even with value stocks, you see big movements and no related news. If I see a good stock getting thumped with no news, I'm a buyer. So today I have 4 value stocks that I'm going to continue to add to my positions. They're well off their 52-week highs. They're all from different sectors. And as they move lower, I'm going to continue to pick up shares. So if that is what you're looking for, please stick around. Whoop. So when I think of value stocks, I think of companies with strong, consistent sales that lead to profits. They have a profit margin. They make money. Imagine that. They also have cash on hand. You can find that on the books. They've got manageable debt that they can handle. It's got a low price to earnings multiple. The 4 that we're talking about today have an average forward PE that is under 10. They've got that onesie, twosie price to sales ratio. Sometimes you hear about the high flying tech stocks right now with that 10, 20, 30 price to sales ratio. And everybody's putting their money into there when the whole market is winning. But when it's losing, they're jumping ship pretty darn quickly. And they also tend to pay a very nice chunky dividend that makes you feel pretty good. Like if you don't catch the bottom, it's probably okay. You can pick up some additional shares if it does move lower. And guess what? You get an even chunkier dividend. So I will mention some of the important data as we move through this, but there's plenty more. So dig deep. If you decide to buy shares of any of these, go do your own research. Now there's plenty more out there as well. Like Walgreen Boots didn't make my list, but it would be a good buy right now, something I might consider adding in my portfolio. So go look around, find those hidden gems. With that said, here are my 4. My first pick is Dow Chemical, ticker symbol DOW. They're makers of all kinds of items that are probably around you right now. Plastics, lubricants, cosmetics, paints, coatings. They kind of do it all. If you drive a car, something in that car came from Dow. I know this because we mold plastic parts for the automotive industry and we use Dow plastics. Now, the chart you'll see right now shows that this has come well off of its highs, over 20% since May and June. They've got about a $40 billion market cap. They've got a PE right around 7, a price to sales that's, let's just call it negligible, at 0.73. Analysts have targeted this thing to be worth anywhere from $50 to $85. So we're at kind of the low end of the spec there. Now, they do pay a great dividend, over 5% currently, and they consistently have been beating earnings. They've got plenty of free cash flow. They've got manageable debt. They've got $3 billion in cash, and they're projecting about a 7% revenue growth. Now, they may have some supply chain issues. That's about the only downside that I can see, just like the rest of the world. But with their decent profit margins and the safety of their dividend, I feel like I am going to be adding more of Dow Chemical. If it goes lower, fine, I'll be adding more. My next choice in the value arena here is Intel. AMD and Nvidia have been killing it this last year. There's no doubt about it. They're great stocks, and I own both of them. But again, I can't quite spot the bottom as they trade at about 50 to 60 times earnings, selling about $15 to $25 billion worth of product, and a price to sales ratio of 10 and 25 respectively. But there's Intel chugging along, selling about $70 to $80 billion worth of product, and they have a price to sales ratio of around 2.8. Big difference, right? So you're looking at Intel with a market cap of about $208 billion versus Nvidia, which sells a lot less with a market cap of $710 billion. So you figure it out. It's kind of like the Toyota Tesla scenario. So when we're talking about value, we're talking about Intel here. But with a PE around 10, vastly different than the 50 to 60 for those other two, and a nice safe dividend around 2.75%. I really like this. So if we're looking at the chart right now, it's come well off of its highs. It's all the way down to about $50 a share, and I think it's a good buy. Every time they come out with earnings, the thing gets beat up. I pick up some shares. The ex-dividend date is a few days later, and I put that in my pocket. So again, PE around 10. Nice safe dividend of 2.75%. I like that. great financial health. We're talking about $8 billion in cash. They've got strong margins. They've got low debt. They've got free cash flow. It's really strong. They've consistently beat earnings. The only issue has to do with growth. So they've got slow revenue growth where AMD and NVIDIA are at a full sprint with revenue right now. So the PEG ratio right now, price to earnings to growth, about 3.11 for Intel, but they are building new factories. So they got new factories going up in Arizona, and they just announced a new $7 billion factory in Malaysia, as you'll see here. So I think, demand and growth are on the way. Demand is definitely there right now in this sector. And I think the beast in this sector, which is Intel, is getting a little restless. So I remember seeing Microsoft take a bit of a breather. You can pull up a chart, but from 2000 to 2015, essentially no growth. And I think it's kind of Intel's turn to come out like this. So, just like little brothers kicking Big Brother, and Big Brother now is waking up and saying, it is my turn. So I am adding to Intel. I continue to make this a larger position. And I think going long term, 4, 5, 6 years out there, Intel's going to be a great buy. My next value pick is Citigroup. This is a bank, and it's definitely lagged its competitors. But let's look up a chart here right now. And you're going to see that the RSI is now under 30, which typically means maybe oversold or undervalued. It has definitely lagged its competitors. I'm going to add in Wells Fargo and JP Morgan on the chart, and you can see how much it's declined in relation to those two. But as a company, they have outstanding free cash flow and a price to book value now that is under 1 at 0.67. That's the extreme value. Essentially, the assets are worth more than the company. But with a market cap of about $121 billion, a PE of about 5.6, price to sales of 1.66, it's looking pretty darn good. I would consider their dividend extremely safe at around 3.4% with room for future growth. So we've seen past growth. I don't see why they're not going to continue to grow this dividend for us. So money in there today could produce a higher dividend rate tomorrow, right, based on cost. So they've got tons of cash, and they're going to make about $20 billion in 2021. Not too shabby. And every quarter, they've been beating earnings. So last quarter, they saw profits surge 48% on strong trading revenue for the third quarter. Now, the only concern here that I see is revenue growth is a little flat. That's the only concern. But with another beat in Q4, I would expect a positive move in this stock off of its lows way down here under $60 a share. So this price, I am picking up additional shares, stuff in my pocket, and I'm going to have that nice big dividend keep me afloat in the future. So I like Citigroup going forward. My next value pick is KMI, Kinder Morgan, and they transport energy all around the country for us. So they're an energy infrastructure company. They've got pipelines and terminals crisscrossing our country, transporting gas, gasoline, natural gas, crude oil, carbon dioxide, and more. But guys, guess what? We need these. We can't function without these types of companies in our country right now. So let's take a look at the chart and understand that it was all the way up to about $19 a share and has come off its highs. So right now, sitting around $15.60. I think it's a pretty good buy price. If it continues to fall under 15, I'll be picking up some more shares for sure. So chart is looking favorable right now. Time to buy some. Now, it's a $36 billion market cap company, and they've got a PE looking forward of right around 12, with the price of sales around 2.24. So everything looks pretty solid there. I also spy some insider trading. So I always like to see insider trading, people that work there, have important positions, picking up additional shares. That sounds pretty good. Out of all these that we've talked about so far, though, this is the one with the highest dividend rate in this group, right around 6.9%. That dividend never wavered during COVID, so that's good to see. And it's grown to 16.5% over the last 5 years. Pretty impressive. Now, they can do this partly because they have great profit margins, 50% gross profit margin, and still about 12%, 11.5% net profit margin after paying us out that nice chunky dividend. Now, cash is not great as of the last quarter. It was around $279 million, which would be great if I had that $279 million, but I don't. But they do, and that's a little bit low for those guys. So I want to see at the end of the next quarter what's reported as far as cash, because that leads us into the biggest problem, which is debt. So they've got lots of debts, but EBITDA growth should make it manageable from what I can tell. So as long as I don't see debt continuing to grow, I'm okay. And that's all based off of solid free cash flow that should allow them to pay down the debt as needed. The other part of this, last part, is share dilution. They don't have any share dilution recently, very, very minimal. So, hey, Kinder Morgan, let's keep it that way. We'll feel all pretty good about it. Manage that debt. And I think it's looking pretty good at right around 15.60. If it falls below 15, I'll be picking up more shares. But I like that chunky dividend, and I like it at $15 if it starts heading down that way. Pick yourself up some Kinder Morgan. So those are 4 value stocks that I like right now. And if they continue to decline, I will continue to add to these positions within reason. I just don't think the floor is that far below me, so I feel pretty good about these investments. Now, if you have any questions, please ask down below. If you're looking for future content like this, please like and subscribe to the channel. We'll see you next time. Thanks so much. Have a great night. Whoop!